Know the difference with Annex Wealth Management? We're going to talk about paying off a mortgage and why that makes sense and why it might not make sense. Joining me, Ericstrom, CFP and a financial planning manager at Annex Wealth Management. Welcome back to the show.
Thanks for having me, Danny.
So the ballpark figure I've seen is about 64% of Americans owning a home. And owning a home typically means having a mortgage, and a mortgage is typically the largest debt a consumer will have. In your experience, is it a realistic goal to pay off a mortgage as soon as possible? I know that's a loaded question.
Well, it comes down to those famous words in financial planning. It depends.
Yep.
Right? There's so many factors. How old are you? How much longer are you going to work? Where are interest rates? And many, many more factors as well.
So our president and CEO, Dave Spano, will always talk about the head and the heart. I guess the heart part gets into the mental aspect of paying off a mortgage. But again, sometimes it depends. It might not make sense. But what about the heart part?
The psychology aspect of this is crucial because many financial planners say, don't pay off a mortgage because the rate is so low, so you can invest and earn more than that, right? I mean, we've all heard that. But it's not that simple because for many people, paying off their mortgage provides a huge sense of relief and a peace of mind, and you just can't ignore that factor.
Maybe you wipe that debt. You do have a lot of cash flow freed up that can be deployed in other ways. That's one financial aspect, right?
Right. That's one of the financial aspects. And also another, mortgage rates are historically very low right now, and your mortgage rate is likely pretty low. Another factor is the younger you are, the more you have compound interest and time on your side. So for a younger person, maybe it's contributing to that Roth IRA that might be an attractive alternative to paying down the mortgage. Here's another factor to consider. How far into the loan are you? Because remember, mortgage interest is weighted towards the front of the loan. So where you are in the loan is an important consideration. Another one, and this is a big one, if you were to pay it off, Danny, where would the money come from? There might be tax considerations to where you might pull that money to make a large payoff of your mortgage.
So I was in my mid-30s and I left a company and was involved in their company stock program and had a windfall, I guess I'd call it. Without talking to a financial planner, I paid the mortgage off, and I still wonder if that would have been a good idea or a bad idea. But mentally, it was kind of nice to kind of clear my mind. I don't remember, but how many mortgages have prepayment penalties? Is that something people need to research?
Yes, because some lenders do charge a prepayment penalty when some or all of your mortgage is paid off. And it's important to check the fine print of your mortgage just to make sure whether or not you actually have that prepayment penalty.
Annex Wealth Management, we work with a wide variety of clients in various ages. Is there a rule of thumb about being mortgage-free at retirement? Does that matter?
Well, I have to address the elephant in the room. It is very common to consider taking a large distribution from a pre-tax account, so an IRA or a retirement plan at work, in order to pay off your mortgage. That is incredibly common that people are considering that. But that decision could have significant, and I mean significant, tax ramifications. So it's incredibly important to make sure that wouldn't derail the success of your financial plan. That's something to think about. But if you set that issue aside, some planners say, you asked about rule of thumbs, Danny. So some planners say always pay off your mortgage by retirement, or maybe even before retirement. On the other extreme, some financial planners, including some very prominent ones, say hold a mortgage for your entire retirement, even deep into retirement. What's the true answer? I think that the actual answer is in between and does depend on your specific situation, all the various factors we're talking about today.
Eric Strom is a CFP and a financial planning manager at Annex Wealth Management. This gets into those planning questions that we might get from clients when we review assets. Does having a 30-year or 15-year, does that make any difference? Do we advise on that?
It does make a difference because remember, mortgage interest is weighted towards the early years of the loan. So you want to know where you are in your loan. And even though you might have a 30-year or a 15-year fixed rate mortgage, did you know, Danny, that the average mortgage is held for significantly less than 10 years because of refinancing or paying it off early? So yes, it does matter because that 15-year, although it has the higher payments, you've got generally making a lot more progress on paying down that balance. So that is an important consideration for sure.
And then there's people that kind of shorten their mortgage just by paying extra toward the principal. Do we see that?
Yeah, and for the right person in the right situation, extra principal payments can make sense. Because what you're doing when you do that is those extra principal payments are reducing the balance. And then when the interest is calculated next month, it's lower. But you've got to weigh that decision against other options for allocating your dollars because it's not always the right choice.
You kind of sort of got at it. And again, this is what the financial planning team does at Annex Wealth Management. But don't let getting that mortgage paid off make you forget about other goals that might be a little bit more important. Credit card debt, student debt. You mentioned IRAs of various types, things like that.
Yeah, it's important to consider the interest rate of the debt that you're considering paying off. High interest rate debt has to take a higher priority. If you've got a credit card at 18% interest, you've got to look at that first. But also don't forget about retirement savings. The younger you are, the more time you have on your side to have that compound interest. Your money can grow and double again when you're in your 20s, 30s, 40s. But once you're in your 50s and beyond, it does become a viable option to talk with your financial planner about potentially paying down that mortgage a little more aggressively.
For investment, retirement planning, tax planning, and estate planning, we do it as a fee-only fiduciary. Know the difference? Our website, annexwealth.com. Click that Get Started button. Start the wealth metric process. Eric Strom, CFP and a financial planning manager at Annex Wealth Management. Thanks for jumping on.
Thanks, Danny.